Glyn, here we are in early October. We're into the final quarter of the year. It's probably worth reflecting on September and a quarter that's brought with it a lot of challenges for the markets.
There have been quite a lot of challenges for the markets, and I think as we go into this final quarter of the year, there are some big macro themes that have clearly developed over the course of the past few months, and I think those are going to be the dominant themes for the remainder of this year. And much more important than the geopolitics that we've worried about, I think quite rightly, over the course of the past few months. The things I've got in mind are some evidence of weaker global growth, certainly divergence of growth between the major economies, US and UK doing well, Eurozone and Japan actually pretty poor performance economically. So I think that's going to be important. We've seen some relative repricing of very important markets. The dollar has now been strong for quite some time, at a particularly strong September. Partly related to that, commodity prices have come under pressure. So there are some very important themes that I think are going to be dominant over the course of the next few months. Some of those things I've talked about will definitely have an impact on central bank policy, which is also clearly diverging. So there's some big macro factors here which are going to be dominant features, not just for the remainder of this year, but I think well into 2015 as well. So that's a big focus for us in terms of asset allocation policy.
Clearly a huge amount going on. Why don't we start with the markets? Obviously a weak period in September for the equity market, and a strong dollar.
Yes.
Lots going on.
Yes. Look, I think the strong dollar was a very important factor. The MSCI World Index of developed markets was down 2.7%. Some markets were actually up in local currency terms. Not surprisingly, perhaps, those markets which had the weakest currency. So the euro area was actually up, Japan was up a few percent. But all of those rises were wiped out by weakness in those currencies against the dollar. The euro was down nearly 4%, the Japanese yen down by about 5%. So we had quite a negative period across developed markets generally. But again, perhaps no surprise in a way, given what was going on with a strong dollar. Emerging markets were particularly weak. Emerging markets fell by 7.5% in the month, and that's taken their year-to-date return now to only about 2%, so below the year-to-date return from developed markets. So it was a pretty tough month with a degree of repricing going on across a number of important markets.
Let's start talking about the causes of that strong dollar then. The US economy looking in reasonable shape and again raising the spectre of the end of extraordinary loose monetary policy.
Well, that's the key. Yeah, the US, the numbers coming out of the US have been okay in terms of the economy. We had that weak first quarter, that was all weather related, we know that. Since then it's picked up. There's been a few patches of sort of weakness around. Construction spending has been weak, so this is not a boom, but it's, generally speaking, it's on track for reasonable growth, sort of 2.5% growth this year and next, that sort of order of magnitude. That enables the Fed with confidence now to stop its asset purchase program. It's definitely going to stop that this month in October. It's signaled that very clearly. So the Fed will no longer be a buyer of securities in the market. It's not going to sell what it's got, but it's not going to be a further buyer. The other important thing that's come out of the Fed recently, and they've maintained this stance for quite some time, is that interest rates are going to stay low for quite a long period of time, and they've maintained that guidance in terms of calendar guidance, that it's still going to be some while before they raise rates. But the important change in their tone in the past month is that they are effectively signaling to the market that when rates finally go up, the pace of rise will be somewhat quicker. And they're now indicating rates that are going to be, in their view, some 0.25% higher next year than they originally thought. They've got a target figure of 3.75% for 2017. So we are now on track for interest rate rises within the next 12 months in the US. First time since June 2006 that rates have gone up in the US. So markets are adjusting to that, and it had an impact on Treasury bonds in the past month, which came off to some degree. So yeah, there's a process going on there of a significant adjustment.
By contrast, a likely divergent policy looking at Europe now.
Well, that's the key thing. We've said for some time, and we're absolutely confident that we've got very divergent policy between the US The Fed and the Bank of England, where the economy remains quite strong in the UK, those two central banks are going to tighten monetary policy. They're going to raise rates in the next 12 months. Probably not as soon as the market expects, but they are going to raise rates. In contrast, the ECB has come out with a further very material loosening of policy in the last month. There was, I think, a very important speech from Draghi, where he basically said that the risks of not maintaining a very loose monetary policy are lower than the risks of sort of tightening too soon. They're worried about structural unemployment in the Eurozone. They're not worried about inflation. All the numbers coming out of the Eurozone show that inflation is very subdued. It's actually 0.3%. It's virtually non-existent. Growth has been pretty sluggish. So the ECB have said that they're going to raise the size of their balance sheet by €1 trillion. I mean, that's a big number. The current size is 2 trillion. So that's a lot of money that's going to be flooding in. They are starting the program of private sector asset purchases in the course of October. They've left open the possibility of actually outright QE in the form of buying government bonds. They haven't yet done that, but it's still a possibility. And they've cut interest rates, the refinancing rate to minus 20 basis points. So you're now getting negative rates on cash in the bank. And of course, the intent here is to push asset prices up, and they're certainly not unhappy to see the euro coming down. It's fallen down by nearly 10% over the course of the past 4 or 5 months. So there's a very, very big change in the ECB versus the US approach. And we've got this loose policy from the ECB for years ahead, as we have incidentally from the Bank of Japan as well, whereas in the US we've got this sort of modest tightening that's going to start. So that's going to have an impact on markets as we go through the next 12 months.
Moving away from the Northern Hemisphere, another area of weak growth at the moment is China.
Yes. Yes.
Many changes there economically coming on?
Well, we've been signalling some concerns about Chinese growth rates for some time. We've seen China slowing down structurally. That process is happening. The Chinese authorities have got a target growth rate this year of 7.5% for GDP. The numbers coming out recently, whether it's bank loans, industrial production, forward indicators like purchasing managers indices, all of those suggest that they're going to struggle to make that 7.5%. But the really interesting thing is that the Chinese authorities have indicated that there's going to be no policy change, at least for the time being, to stimulate growth. So they know there's a rebalancing process that's got to happen in China. They're allowing it to progress. And I think we're looking, as we go through the next few years, at structurally lower growth in China. And guess what? That's having a big impact on lots of other markets, most notably, of course, commodity markets. You know, the iron ore price, for instance, down 40% so far this year. Is it going to bounce back? Pretty unlikely, given that sort of slowing growth in China.
Let's stick with commodity markets while we're here. A broad-based weakness affecting both sort of hard and soft commodities.
Yes, yeah. I think one of the big features of the month, the two really standout features when we look back at September, I think, is dollar strength and commodity market weakness. To some extent, related to each other, because typically when the dollar goes up, your precious metal prices come under pressure. That's what we've seen. The gold price down about 6% in the month, back to its sort of $1,200 lows of the past couple of years. But commodity prices generally under a lot of pressure. Soft commodities, corn and wheat down 10, 12, 13% in the month. That's partly a sort of a very good harvest season, and so a sort of supply issue. But industrial metal prices under quite some pressure. And I think perhaps most importantly, the oil price down again by about 6%. So now down by close to 20% from the mid-year peaks. And this is unquestionably, all of this is going to have a big positive impact on inflation as we go through the next few months. And it will act to some extent like a sort of a tax cut for the consumer. So I think we must view this as a positive for markets, and I think it will flow through to lower inflation. Importantly, it will give central banks much more room for manoeuvre as they go through this process, particularly in the US, of having to rein in ultra-loose policy. It gives them room for manoeuvre. The inflation rate in the US is 1.4%. It's just not an issue. So I think, although it's been tough for individual countries, markets, sectors, this falling commodity prices, it's generally a good thing for the global economy.
So here we are then in a world of increasingly divergent monetary policy.
Yep.
Still no obvious risk of inflation. What's our outlook here?
Well, we're going through a bit of a short-term correction here, I think, where markets, equity markets in particular, are adjusting to this period of weaker growth. I think people are recognizing that the revenue environment for the corporate sector globally is actually pretty challenging. I think we're going through an adjustment in certain bond markets. High yield was particularly weak, for instance, in September. I think perhaps markets are beginning to adjust to their sort of expectations about default rates getting back towards more normal levels. So I view that as a healthy correction, incidentally. And I think generally speaking, this setback that we're seeing, which could continue in the short term, is broadly speaking a healthy correction rather than the beginning of a new sort of bear trend. And I think given the fact that we've got pretty loose monetary policy still from the US, yes, they've stopped asset purchases, but they're going to keep interest rates low, very loose policy from the European Central Bank and the Bank of Japan, I think we are still going to see very strong support for assets that provide any form of yield. I think equities will be well supported. So as we go through a little bit of a setback here, I think there are some interesting opportunities that will emerge to take on a bit more risk again. So I think we will end up with modestly positive return numbers from equity markets for this year, similar sort of position for 2015, but markets are getting a little bit choppier. We're seeing that. And as we move through to this time when interest rates finally do go up in the States, then I think we can expect volatility to increase a bit further.
So once more, remain diversified ultimately.
Remain diversified, I think that's going to remain very important. And what's happening in certain markets, high yield in particular, could give rise to opportunities in due course. Valuations which became very, very stretched earlier this year could give opportunities again. And I think this setback in equity markets is providing quite a nice little opportunity. So yeah, remain diversified and don't set expectations too high for returns, but I think we can still get quite reasonable returns over the course of the next 12 months or so.
Great, thanks, Glenn.